one thing my colleague and I laugh about a lot is there are so many ways to make money in this world, and you don't have to be in a company with a regular 9-to-5 job.
I'd love to dig into that. Tell me, how did you get to where you are? Have you always been in finance? Did you, was it as simple as you got an accounting degree 20 years ago and then you sort of got into the corporate world and you just sort of climbed the ladder? Tell me about how you got to where you are today.
Okay, so where I am today, I'm the CFO or commercial director for a marketing agency, and it's owned by a multinational company. So I'm the Australian division of a multinational company. My company is called Wavemaker. We have offices probably, I reckon, I'm not even sure, but maybe 50 countries around the world, something like that. It's quite big. So if you're in my particular industry, you would have heard of us. We're marketing consultants. We buy media and do a whole range of associated services. My role in that is the CFO, or people say finance director, or I'm actually called commercial director in my organisation. And how I got there is not something I would have aimed for. Like when I was showing you my age, I finished my HSC in 92. So at that time in the 90s, it was a very standard path to do anything in business. You had to go and do a degree. Then you had to go and pretty much join a chartered accounting firm. And sometimes people would go join a company that's not chartered accounting. And then after chartered accounting, you either stayed in chartered or made a move after qualifying to go into a corporate world. And that was a very standard path back then. There are so many paths to get into finance and accounting now. But at the core of it, you do need a degree. In my company, there are actually quite several people at a high level who don't have a degree. So it's not compulsory if you join a company, like doing any sort of business. But if you're going to join a practice, like a chartered practice or a CPA practice that does audits and tax returns and things, then they're not going to look at you without a degree. So what I did is the same. The starting point is to do a business degree with an accounting major. I actually did a double major in accounting and information systems at UNSW. And when I finished uni, I went for all the campus interviews, and I'd done a couple of years of chartered accounting with my uni, sort of together on the side. But, when I finished my degree, I kind of didn't want to be a chartered accountant. I had enough of a taste of it to know I didn't want to do that. And almost all my colleagues were trying to get into the big six as it was then. Now it's the big four, because they offered the best training, not necessarily the best pay or anything. All the pay was similar. But
quick question. For those who don't understand it, and probably me as well, what does chartered accounting mean? Does that mean just crunching numbers, doing the tax returns? What does that mean?
Sorry. Yeah, good question. If your audience is not aware, so chartered accountants basically come from an old English term. There's actually the Society of Accountants in England, and they're chartered because I'm not exactly sure what, but I think it's like part of the Royal Charter, or they've got the assent or the recognition by the Queen and the Lords of Parliament from the UK. So if you're in the profession, right, then you're chartered. Then you're trained underneath a firm which has got usually partners or owners, and they do accounts, tax returns, audits, all that kind of stuff. If you're not chartered, so if you're not part of the society, because here there's a society called the Chartered Accountants Society in Australia, there's no compulsion to be chartered. But if you are chartered, you've sort of got the stamp, like you're a gold licensed plumber, right? You're part of the professional society of plumbers that's done the proper training and the proper hours, and you've been assessed, and therefore you've got your certificate. You can hang on the wall so people know, oh, he's chartered, that he's a properly trained accountant. But there's no compulsion to being a chartered accountant. It's like there's no compulsion to be having a gold license if you're a plumber. You can still be a plumber, you can still get business, you can still be good, you just don't have that license. And it's the same thing. So chartered accountants, like if you're a firm of chartered accountants, you have professionally qualified people everywhere, because that's what people join them for, and then they stay in them or they move out. Otherwise, you're just an accountant, which doesn't necessarily mean you're anything less. It's just you don't have that qualification. There's an alternative qualification, which a lot of people have, called the CPAs. Behind me there. The CPAs is a certified practicing accountant. So it's an alternative body where you still have to do exams and hours and prove skills to get the qualification. It's a different focus because the Chartered Accounting exam is very much focused on audits, accounting standards, tax. It's very, very detailed. In the past, probably still today, it was way harder to qualify the exams to become chartered. It was way easier in the past to qualify to become a CPA. Now it's probably the gap's a lot closer, but CPAs are pretty much all over the corporate world, you'll find. There are chartered accountants who qualify, they go into chartered, they do that for a while, accounting and tax and audit, and if they don't want to stay in that profession forever, then they move into some company and find a career in corporate life. But the people who are CPAs sort of are almost always just start in corporate life, and that's where they end up. So going back to my story, that's what I did. I joined a corporation in the plastics industry. Very weird industry, not weird, but not something I would have imagined. But they just happened to be recruiting. They had a great training program, etc. Large company. Then I qualified, did my CPA with them. Then I went overseas for a while, came back, and then when I came back, I got into the telco industry. So I worked in several telcos, including Telstra. And then I got bored of that after about 7 years. So now I'm probably midway through my career.
Quick question, before we go too far. So chartered accountants do audit, tax returns, and sort of accounting safety. What's the difference with the CPA then?
So your question was about the qualification, but I think you actually meant what's the difference in the job that you do.
Oh, yes.
Yeah. So in the job of an accountant in a company, some of the things you just mentioned, they're more like annual tasks. Like you'll do a tax return once a year. You'll do the audit once a year kind of stuff. So there's other tasks during the year, but the bulk of their work is once a year. So they'll often come into a company once a year as well. So I'm in a company, auditors come in once a year to audit our books, check everything's right, and they sign off saying, yes, everything's right, and they go away. They come back the next year. But within a company, you're doing everything that's involved in running a business. So depending on what your company needs, typically you'll be doing financial reporting, you'll be doing analysis. Usually they're monthly. Most companies I've seen, they do every month. You run a statement. How did we do this month? How much revenue, how much expense, how much profit did we make this month? So that's the reporting side. Then they'll also do the analysis saying, well, what did we budget for? What went up, what went down, and why? And then you'll do the forward-looking planning. Okay, so you've probably got most businesses will have a plan for the year or a budget for the year, split by month, and then you'll be, depending on how your business runs, you might be reforecasting the rest of the year every month, or reforecasting the rest of the year every quarter, or maybe just do it once a year, the budget, and you leave it alone. Then there's your own monthly tax reporting and obligations like PAYG, there's FBT, all that sort of stuff. The in-house accountant will be doing the payroll, the processing. There's payroll reporting and obligations. There might be funding, depending on your company. You might have to have conversations with bankers or other stakeholders who are helping fund your business. Basically, you're helping creating financial forecasts. Now, the good accountants, I sort of listed the core tasks of an accountant in a company. The good ones actually help run the company. So they actually help with the business strategy, the operations, and help run and grow the company. But because they're all very financially minded, every decision you're putting forward, the good accountant will have the lens of financial suitability on every decision, right? I would say just the regular accountants, they run the finances. They're almost like back office accountants where they sit there and you know that all the finances are looked after, reports, tax, obligations, that's all being done in the background by the accountant. But there's the more commercially oriented accountants will actually help run the company as well as do that. So that's the key difference, I would say. The job of an accountant or CFO within a company, and these are all sort of CPA kind of tasks, and depending on the company, accountants get involved in a lot more things than just accounting. Like there are many companies, especially the smaller end, who put HR, operations, admin, and a bunch of those functions under the CFO, because often the CFO is a respected senior leader, and all those sort of admin things which don't naturally fall into the head of sales or the head of product or the head of whatever. They just give it to the CFO to run finance and admin and ops and sometimes HR as well. But as your company gets larger, you've basically got your own. You've got a head of finance, you'll have a head of HR, you'll have a head of basically all those divisions, the larger you get.
Got it. And tell me, why is doing like reporting and sort of predicting what's happening in the future important? Because like, I sort of understand, let's say we sort of look at our numbers, at our current expenses, if for whatever reason there's a black swan event and we're not making any more money, we have a run rate of 6 months. And let's say next month the run rate is down to 5 months because we've made less money. Does that report now tell us, okay, now we have to spend less money?
Yeah, so basically, I mean, a good accountant will always be able to tell you your status as of now, right? You must have a phone with banking app on your phone. So at any point, if you want to know your current status of your money in your bank, you just pull out your phone and you find out. That's for today. But a good accountant can also tell you this: are we on track for the year or not, or are we falling? So as you start falling behind, your accountant is giving you the warning, and the update. Look out much further down. And also, if you're going ahead of plan, a good accountant will tell you, because if you're falling behind, and the more you're falling behind, the earlier you have that notification, the earlier you can make decisions and take corrective actions to arrest that slide. And also, the earlier you know you're actually going ahead of your plan, you can make corrective actions or make decisions to avail of opportunities that you didn't plan for, because now your business is growing faster. So you need to know, as a business owner or entrepreneur, if you're on track to your plan or not. I mean, you must have a plan. I mean, whether you're in a small business or a large multinational like I am, you need to be aware of what's happening financially in your business so that you can manage your business to meet your goals. Because I'll just give you an example, like in the startup world, because I do a tiny bit of consulting to some startups. Let's say you've got a great idea, a product or a startup, and you've built it, and people start to like it, and you start to get some traction, and people are using your startup, which is great. You get some suggestions from people, your users, your early adopters, you make some improvements, you're doing this, the more people getting attracted, you're feeling good, it's getting popular, but there's not much money coming in. So you're spending all your money developing it, making it more popular, but no one's actually paying for, you're not actually monetizing much of it, even though you're growing your users. At some stage, you're going to run out of money, right? If you're spending 10 grand a month on your startup and only 2 grand a month is coming in or something like that, that's a deficit of -8. At some stage, you run out of money and everything has to stop. So what good's that for anyone? It's not good for you, not good for your customers or anything. It's that the whole thing's just sad, and it just becomes a waste of time. So you need to know your financial situation. You need to know what your limits are. You need to then set some priorities and goals, and then systematically go about building your business. So, cash flow is, for a small business, I think the most important thing. If I could just define, cash flow, it sounds self-explanatory, but I'll just explain it. Your monthly cash flow is just a simple calculation of how much money is coming into your business, into your bank account, versus how much is going out, of how much you're spending. So cash in versus cash out. Very simple. That's your cash flow. Okay. Any business can really only stand on its own 2 legs if it is bringing in more cash than it is spending out the door. Now, there will be times when the monthly cash flow will be negative, and that's still fine, because you might be paying an annual insurance bill, right, which is high. So you've got 12 months worth of insurance coming out in the month, but you know that that's actually spread out over 12 months. So as long as you can afford it in the scheme of your overall business, that can be fine. But apart from those big one-off things, which don't happen every month, generally every other month you should have more money coming in than going out the door. Now, this is a salutary lesson that every business owner should know. I'm just going to give an example. It was actually a public example last year, the year before. There was a startup bank called Xinja, or Ninja, I'm not sure how you pronounce it. And if you don't know how a bank works, banks get money from people saving and pay them a low interest rate, like 1%, and they lend that same money to people who want to borrow for like a home loan at like 4%. So they're paying at 1 and they're getting money in at 4. So that's their margin, their spread, and that's how they basically make their money. Now, they've got different sources of attracting money through saving deposits and bonds and other things, and they've got different types of lending products like home loans and credit cards, etc. But really, the lending products is how they get money in, and the saving product is how they pay money out. So simple, that's the bank. Xinja started a couple of years ago. They offered amazing interest rates to their savers. I think at the time it was like, it was ridiculous. Like the banks are offering somewhere between 0 and 2% for saving, depending on your balance. And I think they were offering 3 or 4%. So they were offering very, very high rates for savers. So they got a lot of interest. They got a lot of people, wow, okay, this is a bank. I will put my money there and earn 4% rather than 0.2% with my local Big Four bank. However, what they forgot to do is they forgot to lend money. So they had all this new users coming into their bank, and they were paying them out money every month because they were paying interest for saving, but they never launched a lending product, right? Now, Xinja, the reason I give that example is it was really big. It was written by so many people. It had so many backers in the Financial Review. I think they won some money, new bank awards and all this kind of stuff. But they forgot a very basic part of business, which is, okay, you're growing your users, but if all you're doing is paying money out and there's no money coming in through your lending product, at some stage you'll run out of money. And they ran out of money after about 2 or 3 years. So they closed down. They had to return all the money back to the people who had accounts with them. So none of the savers lost money, because if you're a bank, the government guarantees up to, I think, $1 million worth of loan balance or account balance. So all the people who put money in got their money back, but the business shut down. So that's why cash flow is very important. No matter if you're small or if you're big, you must ensure that there's money coming in to cover the money going out on a monthly basis. Not necessarily every month, but most months, so that over the year you've got enough cash to make some money and grow your business, and then you can decide how you want to reinvest that into your business.
Now, when you're like a small company, what's the difference between cash flow and profit? Because let's say cash flow might be really inconsistent for a smaller business. Let's say they have a high-end product that costs, say, $5,000. Month, January they could get 2 customers and that's $10,000. Then the next month they can get 6 customers and that's $30,000, and it's all over the place. It's not going to be consistent. Or some months they might get 0 clients. How do you figure out cash flow then, and do you just look at profit then?
So if I can explain, the key difference in those two things is whether an expense that you're paying for is a regular operating expense that you would expend in the course of earning revenue, or whether it is what I call a capital expense, where it is something that will give you benefits for more than a month. Okay, so if you have a business, let's use Ubers. Say you want to drive Ubers for a living, okay, and that's your business on the side. When you pay for petrol for your Uber, okay, that is considered an operating expense because you do that all the time. There's no benefit to you for greater than however long that lasts in your tank, which is maybe a few days or a week or 2, something driving Ubers. Every time you drive, you get money coming in from your customers through your Uber account or something, and that's your revenue. And every time you're spending, you might be spending on fuel, you might be spending on car washes, you might be spending on things to maintain your car. That's regular operating expenses, okay? However, let's say you do that, and then after a while, you go and buy a second Uber, a second vehicle, because your business is expanding. That second vehicle's cost you, say, $30,000. Now, that is not a monthly operating expense, okay? Because that's going to give you benefits for way longer than the month, okay? In the same way as insurance. When you pay for insurance, you might be paying $2,000 for the insurance for the car. That's not a cost of the month. That's a cost spread out over 12 months, in actual fact. So what accountants do is every item of expenditure that comes in the company, they categorize as either an operating expense, in which case, yes, this is part of my running costs for January or February or whatever month I'm in. Or they'll say, no, this is not a running cost. This is a cost to be spread over many months. And depending on what it is, they'll decide how many months to depreciate that cost over. So if you spend $2,000 this month for insurance, I'll say, okay, 1/12 of that should go into January, and the other 11/12 I still have to pay out of my account, but I'm going to put that on my balance sheet. And the next month I'm going to record 1/12 of that as an expense, and the next month 1/12 as an expense, etc. So just that example there, you can see how your cash flow, which is cash in and cash out, is going to be different to your profit, because your profit will probably have the same money coming in, but the cash out will also then have 1/12 of the insurance cost added on as an additional expenditure item. So that's the key difference between accounting profits and cash profits, is when you look at accounting profits, the accountant in the company will have recategorized any items of expenditure that don't belong in the month and have spread them across 12 months. Or if it's a car, they might spread the cost of the car over 5 years or something like that. Or maybe you've prepaid some expense over 6 months for some reason. They'll like spread that over 6 months, whatever the nature of that expenditure is. Also, can also happen on the revenue side, less commonly, but let's say a customer subscribes to your service for a year. You've got some kind of subscription model. And if it's a 12-month subscription, they've paid you today, that revenue, okay, the cash is coming today, correct? So for cash flow, it's cash in, cash out. It's really simple. But for accounting profit, you're going to record 1/12 of that this month, and then 1/12 the next month, and 1/12 the next month. So you could have a number of items of revenue spread out over many periods, and you could have a number of items of expenditure spread out over many periods, depending on what they are. And therefore, if you're just looking at your monthly profits, you're looking at your starting cash in and out, and then plus or minus any spreading of revenues and costs. And that's actually how you get your monthly profits.
Now, if you're too zoned in on cash flow, is there like a possibility that it probably doesn't happen much, but you're cash flow positive, but you're unprofitable because you're scaling, you're taking on a new agency to help you with marketing, and there's a large sign-on costs, you're buying new laptops, equipments, cameras, and you're still cash flow positive, but you're growing and you have all these other expenses, and as a result, you're unprofitable, and you don't even see that you have a runway for the next only 3 more months. Is that possible?
Yeah, absolutely. You can be hugely cash flow positive and actually making losses, as in accounting losses. Conversely, you can be hugely cash flow negative and actually making accounting profits. If you want, I can explain both scenarios. You're a business that owns and has a fleet of Ubers. This month, you go and buy another car. So this month, you're hugely cash flow negative because you just forked out 30 grand on a car, right? But before this month, the last month, the month before, you were making roughly 3 grand a month profit. Let's say 6 grand coming in, 3 grand going out, right? But you've built that enough over a year. You've now got 36 grand in the bank because you've done 3 grand times 12. You've decided to double your business, you go and buy another car for 30 grand. So for this particular month, you're cash flow negative, but you're not unprofitable because the cost of that car is going to be spread over the next 5 years.
Yes.
Right? So when you talk about accounting profits, you can actually still be very profitable as well as being cash flow negative. So I just gave you one example for a month, but that could happen over a year. A company could invest a lot in an asset or building an asset for a year, right, which is going to have benefits over the next 5 years. So the cost of it won't be applicable just for the year. It'll be applicable 1/5 in each year. So the profit will be very different to the cash flow. The other scenario, how can you be cash flow positive but accounting losses? Okay, let's say you're growing your business. Okay, you're only earning 2 grand a month from your Uber driving, but you're spending 4 grand a month in running the Uber because you don't have enough bookings, for argument's sake. Okay, that can't continue forever because, as I said, if you've got 2 grand coming in, 4 grand going out, you're running at -2. So at some point, you're going to run out of money. So at some point, you go to your funder, bank, stakeholder, whatever. Can I please borrow $20,000? Or can you invest $20,000 in my business, and then you can become a co-owner of my business so that my business can continue to run and hopefully grow and hopefully make profits and hopefully return money to you and to me. But that's what a business does, goes and seeks capital. So you go and seek capital. So 20 grand comes in from someone or a bank or a stakeholder. So that particular month, you're hugely cash flow positive, because you've got 20 grand in the bank, but your operating rate day to day is still running at +2, -4. So you can still be running at a loss, but have cash positive for that period. So both situations can happen. Cash flow and operating profits, if you're not doing anything in terms of expenditure that lasts past that period or revenue, then cash flow and accounting profits are exactly the same. But the moment you have items of incoming deposits, which are not revenue, or items of capital, or things that spread across a month, such as someone buying a 12-month subscription in one month, or you have items of expenditure which aren't just belonging to the month, such as an annual insurance cost or a purchase of a vehicle, then your accounting and cash will be different. And they'll be different for as long as those differences occur. And then at some stage, they should actually then come back to normal, unless you've got more expenditures.
Beautiful. And what's your recommended so I heard this quote from Bill Gates where he always has 12 months worth of expenses in cash all the time. Is that a crazy number? Do you have a recommended time frame on, if my revenue went to 0, how much multiple of my monthly average expenses should I have in cash?
Yeah, look, it's a bit of an old piece of advice, still very relevant. I wouldn't necessarily say you have to follow that or you don't, because it really depends on the nature of your business, how much capital you've got employed, and what your other sources are. So that sort of advice was basically intended to say you should never run your business so close to the edge that you've got nothing backing you up, so that if suddenly there's a shock, customer goes away or the price of something goes up, then your costs go up, then you can't survive. You should have plenty in reserve. That's the idea. And so he said you should have a year's worth in reserve, kind of stuff. And that's although I have nothing against the advice, I'm hesitant of recommending that to people, because today's businesses are very different to the businesses of Bill Gates of the 1980s and 90s. You don't need so much capital to start a business. There's the digital world and evolution. We're actually not spending you're not spending hundreds of thousands of dollars of down payment, on a building to have a shop, to fit it out, to sell something. You're doing it all online for hundreds of dollars, not hundreds of thousands of dollars. So depending on your business, it can be really, what you need is dependent on your situation. Like what I would suggest is, if you're running a small business or a bit of an entrepreneur, how much money you need and what you need to do to manage it. Just some general advice. First thing I would ask if I came into a startup is, okay, how much money do you have in the bank right now, like your bank account? Okay, so pick a number. How much can you borrow from that bank? What's your unborrowed limit? So let's say you've got an account with the bank. For argument's sake, you've got $10,000 in the bank, it's cash, but you've got a limit with the bank. You could borrow another $20,000, so like an overdraft or some kind of limit the bank's given you, but you haven't used it yet. So because you're positive 10, you don't need to go into negative. So you've actually got $10,000 in the bank. You've got a $20,000 unaccessed overdraft. Okay, then what other sources of funding you have? Who's the owner? If it's yourself, how much more could you put in? So you've got your own private bank account or shares or things over here. How much money there would you be willing to put into the business, or could you, right, before you say no? Maybe that's another 20,000, maybe that's another 30,000 or 40,000. What about your friends, your parents, anyone else you would like to invite into the business to invest in your business? How much could you potentially get from them? Maybe another 5, 10, 15, 20. And then before you go to what I'd call making a pitch to shareholders for extra investment from other people, just how much can you easily access from your funds, right? So your situation might be, I've got 10 grand in the bank, 20 grand, I could get more from the bank. I could put in 20 grand more for myself. I could probably find some friends and family to put in another 30, 40 grand. So total, I've got 100 grand as my source of funding, as my cap maximum. You need to work that out for yourself. What is your maximum? And if it only stops at you can't ask anyone else, well, at least then my maximum is only 30 grand or something like that. Right, so the reason for finding that out first is to know your parameters. What are you working with, right? So you don't end up like Xinja, which gave money out for 2 years and forgot to bring money in, and you have to close the business down. Then you work out your cash flow rate, right? So how much money is coming in, how much is going out every month in your business? Is 6 grand coming in, 3 grand going out on average every month? If you look at the last 3, 6, 12 months, if that's your average and you think, yep, that's likely to continue, that's great. You've got a cash flow positive business because more money's coming in than going out, and you've got money in the bank. Now, the set of decisions you have is, what do I do with that positive cash flow? So I've got 10 grand in the bank, and it should be growing by 3 grand a month, all things being equal. So in a year's time, I'll have 36 plus 10, I'll have 46 grand. In a year's time, I'll have another 36 on top of that, which is 82 grand or whatever. So at what point do I want to invest some of that into my business for more capital, more equipment, more computers, whatever my business is doing, whatever I need, and how much do I put in? So I might say, okay, my plan might be to reinvest all of it, all that 30 grand at the end of 9 months. When I get 30 out of the 36, I'm going to buy a bigger computer, server, machine, whatever it is that I need to then give more capacity for my business to grow faster, etc. So there's a whole set of decisions which your accountant should be able to help you plan by looking at your current existing capital and your current cash flow rate. Now, if your current cash flow rate is negative, different set of decisions. So same scenario, you've got 10 grand of cash and you've got 30 grand of capital you could access, but your cash flow is -3, not +3. So you're earning 3 grand a month from your business, but you're spending 6 grand a month. So your cash flow rate is -3,000. And if you've got 10 grand in the bank, that's only going to last you 3 months, if you follow, roughly, before your bank gets close to zero. And then you're going to have to go to the other sources of capital. And the other sources of capital might be 30 grand, but then you've got another 10 months after that. So on that rough calculation, you've got about 13 months worth of operating before you run out of money and you have to shut down. That's if you do nothing. So your good accountant will tell you, okay, we've got 13 months to survive here based on how much capital we can access and our cash flow negative. Well, the first thing first, let's become cash flow neutral. So we've got 3 grand coming in, 6 grand going out. I need to close that gap so that there's less going out or more coming in. So let's divide that into 2 simple tasks, revenue up and cost down. Revenue up, how do I get more revenue, depending on what my business is? How do I attract new customers? What are the ways to bring new customers in to get more thing? How do I launch new products? So do I just sell one thing or can I sell 3 things? Why not sell 7 things? So the more I sell, the more my existing customer base will buy. And if I've got more customers coming in can buy 7 things rather than 1 thing. Pricing. If I'm selling, something for $10 a unit, if I made that $10.50 a unit, just a tiny increase in price, that would increase all my revenue 5% instantly. Would that drive many customers away? If not, maybe increase my price if the market will bear it. Or maybe get more exposure through other channel partners. So if I'm selling something just through my own efforts, why don't I try reselling through partners or giving, different people a different slice of the pie by exposing my product to their kind of channel. So there's all these different types of activities you can pursue to try and increase your revenue, hopefully getting your 3 grand a month higher and higher. The other side of it is cost down. So look at what you're spending. So if you're spending 6 grand a month, and obviously you've got a whole different bunch of tasks to try and increase your revenue, don't forget to look at your costs. What am I spending my costs on? Can I do that more efficiently? Are there cheaper providers that don't impact the ability or the quality of my product? Can I reduce? Can I eliminate? Can I outsource, etc.? Depending on your business, that's a separate exercise to look at. And then hopefully then you'll be able to put together a plan of saying, well, with these initiatives on the revenue upside and these initiatives on the cost downside, that gap of -3,000 a month should get closer, and that might take, let's say, 6 months or 8 months to get there. But by that stage, I'm running at cash neutral. I might be at 5 grand a month revenue and 5 grand a month cost. So if it's taken me 6 months to get there, I've still lost some money in that time. But from that point on, I no longer have to draw on my capital. I no longer have to draw on my bank account or my stakeholders to fund my business, because now I'm at a self-sustaining level and now I can hopefully continue that and grow. So I just gave you an example of how an accountant would come into a business, look at the situation, look at your current status, your parameters, I guess I would say, your sources of funding, etc., look at your cash flow, look what you can do, and then work with the owner to come up with a good plan to saying, here's what you should do, here are your options, etc., and help you develop that. And the key thing here is you're going to have to prioritize activity. And like with any small business, like when you're developing your product, your app, your startup activity, you must have 40 good ideas to put into it, but you can't do all of that at once. So you've got to prioritize. It's the same thing with a financial plan. There are so many different things you could do. I just gave you 5 or 6 things you could do to attract revenue up. You can't do all of that. You should prioritize. And that comes through talking and understanding your business, likelihood of success, your willingness to do that, which one of those activities you're wanting to do. Do you want to launch more products? Do you want to do more marketing to attract more customers? Do you want to increase the price? Do you want to go find channel partners to resell or whatever? They're all different activities. Which ones do you want to prioritize and do? And that's really what a good accountant will help you do.
Yeah, so let's say there's like a business owner that might want to sort of move to like a new initial sort of grow further. So let's use my example, for example. I went from doing drop shipping and e-commerce to now building an education company. But as I'm building this education company, hiring developers, building out the team, a lot of software costs, I'm cash flow negative. But I have a pretty good war chest, so I know that I can ride this out for the next, say, 12 to 24 months, and there's a good chance it'll become profitable by that time. Now, obviously, there's a lot of risks there that may or may not happen. Do I stick to that goal and go all in and really focus on growing and pushing this education company, or should I split my time up and open up another e-commerce dropshipping business and make some small positive cash flow that I know will happen, but now I'm splitting up the team and time?
So I would say, look, without knowing the ins and outs of your business, but in that rough situation, if you're currently cash flow negative, what is that negative delta? And how insurmountable is it to get it to neutral, right? So if you're making $3,000 a month but spending $6,000 a month, that delta is quite a lot because you're spending twice the rate of your revenue. But if you're earning $5,000 a month but spending $6,000, the delta's not so much. You're only a little bit short, right? So the reason for knowing that amount of negative cash flow is how many months can you survive till you run out of money. It's going to be 12 months or 24 months or whatever. So that's your parameters. That's what you've got to start with, right? Then you decide, okay, how am I going to get this business to become cash flow neutral and then cash flow positive? Because you having that 24-month window, that shouldn't mean you do nothing for 24 months because then you just fall off a cliff and have to stop, right? What you should be doing between now and then is saying, I want to target. I still want, let's say you've got 24 months worth of capital up your sleeve at today's current burn rate of cash. Let's say you want to be cash flow neutral within 12 months so that even if you don't, you've still got 12 months up your sleeve, right? If you follow. So let's cut your available time, which is your capital, in half. So if you've got 24 months worth of savings for your business, cut that down to 12, and then your target is to grow your cash flow negative variance, that delta, from whatever it is to zero in that 12 months. And you need to decide whether that's possible or not. Because if it's not possible to do it on its own, and you've got some time to do some other activities on the side to earn $1,000 a month to put towards that $3,000 a month delta, and it's not going to dissuade you too much from that business. So it's not going to take your focus off it. You're not going to spend 50% of your time doing this just to earn the $1,000 because then you're taking your focus off your main business. If you can do it easily, that might be a good way, like depending on the time commitment and how easy and how much expertise you have in doing that other side business to help fund your main business. I do just have some general advice. There are entrepreneurs I've met who have this funding problem and they say, Yana, but I could do something else on the side to help money. They end up doing too many things on the side. If you do too many things on the side because you know how to do it and you make money, it's very seductive because you can just keep doing it and earning more money. But your whole idea was to build this wonderful idea and business. And if you're doing these things on the side just to earn $1 to fund into here, but you're not improving this, you're stuck in a loop. You'll never stop doing that, right? So my advice is, how are you improving this main business? If this is a negative $3,000 a month delta, there's not enough people paying for it compared to what you're paying to run the business, you're going to have to keep on doing your side hustles to fund it because this business is never improving. So your mind should be focused on improving your business, the financials of your business, which means growing your user base, growing your products, making your products more attractive, making your products front of mind in your potential customers' eyes, making your products more sticky, having great partners, having people who vouch for your products. All these things are activities you should be doing to grow your business and making it better, and which should result in more people buying your products and services, increasing your revenue. That's how you improve your business. In the interim, whilst you get there, if it isn't too much time and effort to do something on the side to make a quick dollar to help funding this, that's fine. But I actually have seen examples of people who are caught in that situation and then they do a couple of things to fund it, but they forget actually to improve the core business. Because if you never improve it, you're always going to be $3,000 a month negative. You're always going to have to do it. So the idea is to do these things on the side, perhaps as a short-term measure for funding only, but focus on this business to grow it. Because once this business gets to cash flow neutral, you shouldn't have to worry about those side things ever again, because now the business is paying for itself. And then you're in a different set of conversations and mindsets on now, how do I grow it more? Money's coming in, more money's coming in than going out. Then how do I, make that bigger and bigger over time?
Yeah, what's your thoughts on like side things over an investment? Because I have found myself in rabbit holes over like weeks at a time where I'm researching about real estate or stocks and ETFs or crypto mining and building mining rigs. And I'm like, I know my business, I can probably make a much better return on my business, but for some reason I'm watching people say you shouldn't let cash sit there, you want to make your cash work, and all of a sudden now I'm looking at these different things and I'm always bouncing between, okay, should I find a passive way to reinvest my money or should I just focus on the business?
The question is really around time and focus. So if you have a lot of money sitting there not doing anything, some people will argue that that's a waste. It's a waste of a resource. You could be doing something with the money. Now, if you're doing something passively with the money, such as just putting it to work, go buy an ETF or something, that's hopefully making your money without having to do anything. So you can focus on your business and the money's not being wasted. Your 10 grand sitting on the side might become 12 grand in 6 months' time or whatever. But if you're going to do something that requires time and effort, that's when it starts to become dangerous. The moment you need to put your mind and effort into it, you need to have a really conscious decision, and I would recommend you decide how much of your time you're going to divert and spend no more than that. Because the reason you go down into rabbit holes and things is because you haven't set those parameters for yourself, for your own time. So if you don't have, there's a different saying I'm coming to, which is kind of relevant for this. When you come across a sticky decision, an ethical or moral dilemma, so you've got an opportunity to do something, and whether you should or not, you're not sure. If your core values are set, all those decisions are really easy. You can say yes or no because you understand your core values. If you haven't set your core values, those decisions become difficult. It's the same thing with this, because you're talking about time. If you haven't said to yourself, I'm only willing to spend 1 day a week on side activities because I want to focus 80% of my 5 days a week, and I want to give 2 days to myself on weekends to rest and recover. If that is your decision, then you then have guardrails to work with. So then you decide, okay, I've got this money sitting on the side. I'm going to put half of it to work as an ETF, and the other half is what I'm going to play with to do data mining, crypto, whatever things I need to think about. But I'm going to limit that to 1 day a week because that's the decision I made. And then when it stops, I stop that. I go back to my 4 day a week job, which is building my core business, which I hope is going to grow very successful. And you can't do everything because some people who don't put that time frame on themselves, they don't have their own parameters. They end up working 24 hours a day, burning themselves out, or they focus too much time on things that aren't going to be sustainable for their life. I mean, we spoke earlier in this conversation. There are millions of ways to make money in this world. It doesn't mean you need to spend your time doing everything and looking into every single opportunity to make money, such as flipping Tesla cars because of the government rebate and crypto mining and ETFs and all sorts of things in the world. You need to pick, but you actually, more than picking that, you need to limit your time. You need to focus your time and schedule your life first, So if I was a young 20s entrepreneur now, the first thing I would do is give myself 2 days a week for not working as a weekend, right? The weekend doesn't have to be Saturday, Sunday, by the way. Some people actually, mix up their working weeks as well. But give yourself the time, because if you don't have time to think, rest and recuperate, you actually will not be effective in the long run. That's a key skill that I never learned until way later in my life, because when I was growing up, it's just the harder you work, the better you looked in front of your managers and you thought I was a good employee. But you burn out and you become less productive and less effective because you're too stressed, you're too burnt out, you're constantly working. So you need to rest. 2 days a week is fine. And by the way, not all entrepreneurs do that. Some of them only give themselves 1 day a week, sort of pride themselves on working 6 days to accelerate their business faster. But, that's the personal decision. But then within the time that you give to work, as opposed to for yourself, how much do you want to spend on, you might have 2 businesses. How much do you want to spend on business A and business B? Or you might have 2 businesses plus a side hustle. So I've got business A, I've got business B. This is the thing I really want to explore around crypto mining or...
Yeah, I'd love to get your thoughts, Lakun, because I know my education company has the best shot long term. I should be putting 100% of my time into it. But for some reason, I'm getting distracted by crypto mining, and then it could be possible reasons. It could either because the main core business is starting to get hard. It could maybe be because I want to make the money that I've sitting for me work. It could be because it's actually a fun, interesting hobby and I'm really enjoying it. Or it could be that I see that this is it has a major long-term sort of return in crypto mining if I do it correctly, and I've done a lot of research. So I'm finding myself distracted and I'm justifying why I should be distracted, and I don't know if that justification is good.
I would say you've clearly got an interest in it, right? So it's not a passing thing you saw. From what you're saying is, you could see it being something fun. You could see it being something that earns you money. You could see it being something potentially you could actually do as a living, even if you got really successful. So you've got a keen interest in it. So it's more than a side thing. If I was you, I would say, let me give some time to this and let me put a limit on it. So that might be, my core business, which you've defined as your education business, that is what you define as your core. You should be spending most time on, because you think you're fully believing in your own idea that it's going to succeed, and you know why, and you believe in your product and your offering. Great. So 100% should go there. But I'm going to limit that to 80% because I'm going to put 20% into exploring this crypto thing and seeing if I can make it work. But that's not going to be forever. I'm going to give myself 2 months. That's my limit, right? And if at the end of 2 months, I can't make it work as something to do continually, or I don't think I've got the resource, capability, skill, time, effort, money to do it properly, then I'll shut it off. Then I'll return that 20% back to my normal business or find something else to do. So instead of being distracted and wondering, am I doing too much or not, I'm saying make a conscious decision, right? Make a conscious decision, Andy, of how much to put into it. What are your parameters? When will you stop? Oh my God, that's something I should have said earlier. People don't know when to stop. When am I going to stop? When am I going to stop? Like in business, there's a hard stop when you run out of money. That's when you have to stop, right?
Yeah.
But you could have made a decision way earlier. You know you're running out of money before you run out of money. At what stage do you stop this activity to stop the cash flow running out, right? So that you've still got some capital left to do something else with, right? That's what you should be doing.
On that topic of sort of learning when to stop,
yeah.
How do large companies that have sort of really like free trials, low-end products like Netflix, Uber, Amazon, Duolingo, where they have, it's $20 a month, or it might be they only make 10% of every sale that a customer sells on their platform. When it's a huge upfront cost and huge ongoing cost for all the developers, and the product is so low end and it's cheap, and they're relying on word of mouth, and you can't really predict when word of mouth will kick in and it will exponentially grow, how do they manage that risk?
So, but those sort of examples you gave is like there are so many products that come in. Like I work in a business. We've developed, launched products, and then within a year, they didn't work. Like we didn't get enough revenue, enough money in. So we give ourselves a year, and if it's not working in a year, if it's not even getting enough traction, or we don't think it's going to go fast, we stop investing in it. So we say stop after 12 months. It's a 12-month window we have, right? Mm-hmm. Other projects and things might have much longer windows. A company might be totally reinventing itself. It's got a lot of money, but it's going to pivot to do something quite different. So it knows for the next 2 or 3 years, it's going to be spending a lot of money investing into this second thing, not expecting to make money yet, but there will be an end date. The end date might be 4 years or 5 years where it's got to work. Otherwise, we've got to start putting money into it as well. So the answer to your question is really determined by your available resources, your available time and capital before you say stop. So, for example, in your business, if you're losing money today, you've got 24 months worth of capital left based on today's what I call cash burn rate, how much you're burning every month. It'll only last you 2 more years. You might want to say, I need to shut this business down in 18 months' time because I still need to have some money left, that's 6 months worth of capital to start a new business. So my actual shutdown date might be 12 months or 18 months. It's not going to be 24 because what's the point of running until it dies, Then you've got nothing left. So if your shutdown date is 18 months, so it does not improve in 18 months, I have to shut it down because I cannot enter a new business with zero. I must at least have 6 months worth of capital or whatever your decision is. Then between now and that 18 months, what am I going to do? I need to improve it. So all those revenue up things I mentioned before, cost down things, so they're the things I need to focus on and do to improve my revenue and lower my cost ideally to get that cash burn rate close to zero. And hopefully that's done well before the 18-month time. And that's the sort of plan you have. Then within the context of that sort of business plan, you might want to carve out, as I said, 20%, 1 day a week to do some other things. But those other things, like as I said, because they're short-term and initially the main objective is to earn some money to pump into your main business, which is your longer-term objective, within 2 months you need to know whether it's going to make you money or not. And if it's not going to make you money, you need to shut that down. If it is going to make you money, okay, then there might be a decision you make at that point is, okay, I can work out how to make money here. I might only be able to make $400 a month, but my delta in my main business is negative 3,000. Do I want to spend more time here? Maybe make it 2 days a week to try and turn that 400 a month into $2,000 a month or something. But then I'm losing focus here on my main business. But that's a decision you have to make. Or do I just maybe continue it at that level and think of it as my funding source? I'm making some money, but not to become a crypto guy for life. It's to earn some profit to put into my main business, which I want to focus on. So the purpose of you doing these side things needs to be very explicit in your own mind. You don't need to tell anyone else, but you need to know why you're doing it. Otherwise, you'll suffer the death by distraction. You do this and this, and there's a good idea here. Like told me about that guy who flips Teslas. Let me look into that for 3 days. You won't spend time on your main business. So you don't spend time on your business improving it all the time. It has a greater chance of failing. You have to actually spend more time in it to give it a greater chance of succeeding.
Yeah. Now, what's your advice on trying to find a good accountant that can really help you run and improve your sort of company? Because I've dealt with probably 2-3 accountants by now, and they do your tax return, they help you with your BAS, maybe they show you how to structure things and have a holding company and a trust fund. They might help you with getting grants and with COVID sort of benefits, and they'll give you information on that. But it seems like there isn't much like sort of what you're sharing, like these good accountants that really work with you, see your numbers, see your expenses, ask, hey, you should slow this down, you should ramp that up. How can we get you profitable? It's where do you find that?
So look, basically the sort of stuff I've told you or sort of tried to describe to you in this conversation is I've categorized that all under like business planning or business strategy. Like I'm trying to help you plan, strategize, and give you advice on how to structure your personal time, your business. And like if I was to know the actual numbers of your business, I could then give more advice as to what I think is worth it or not with my experience. And then ultimately it's all your decision, but at least you've got some expertise of someone who thinks in a logical, structured manner to say, okay, well, my expert is telling me this, this, and this. This is his recommendation, but there's some things there which are open for me to do. So, you might have 4 different side hustles to explore, not just one. And I might say, well, you might put 2 days a week and do 2 of them, or just 1 day a week and do 1 of them. But you might have a different opinion, right? And but that's all on business planning. What you just described, people who help you do your BAS returns and tax obligations and this and that, they're your typical accountants. They'll actually help you do the reporting and analysis and tax and legal obligation side of things for payroll, for employee contracts and BAS returns, fringe benefits returns, income tax returns, all sorts of things like that, even helping you with getting government grants and things. But that's, in my mind, I call all that reporting and compliance kind of activity. There's a different skill set around business planning. Now, for reporting and compliance, you can find a whole bunch of accountants. Even the local suburban accountant can help you with that kind of stuff. You can find bookkeepers everywhere. A good bookkeeper can do most of that for you. But business planning kind of people, the sort of things I'm describing, the first thing I'd say, how I found, I actually mentored 2 startups. How I found them is actually they found me. So you would have networks, right? Being in business, go to your networks, find people through like your startup communities. Your LinkedIn community is very good for networking. Reach out to people and ask them, do you know someone who's good at business planning or accounting, can help me with my business and work with me in an advisory capacity, short-term, mid-term, long-term, not quite sure, but so I need some help in that. And people might know people, right? And so it's like a really good bit of advice I got from a while ago when I was looking for a job many years ago. I didn't really know where to start, and recruiters they don't always return your calls, and you can't rely on recruiters to find you a job. You've got to manage it yourself. And someone said, well, who are all your networks and contacts? Divide them up. You've got social, you've got family, you've got old colleagues and blah, blah, blah. And list them all out. People you could pick up the phone and talk to because you know them, or people who take your call. And then you ask each one of them whether you say, I'm not asking my neighbour, can I have a job? I'm not asking my old colleague, can I have a job? I'm saying, hey, I'm out of work at the moment. You know me. Do you know anyone in your circle who might have something? And that's how I found my job. It didn't come through a recruiter or whatever. It came through a contact in a different circle, but they happened to know someone in their circle who mentioned to them the previous week, my accountant's just left, I need a new accountant.
Now, do you recommend the reporting and compliance to be different and separate from the business planning, or something that can offer both?
I don't recommend one way or the other. I'm just saying many of the people who offer the reporting and compliance type activity, they are professionals in that activity, and they will do that for a lot of clients. And so they won't really have the time, it might be a bit unfair on them, or the expertise in business planning, but mainly the time, because they're probably dealing with you and 40 other clients at the same time, okay? So they'll be very efficient in that. But some of them will do all of it, and some of them are very good. And they're harder to find, actually, because people who can really sit with you and be a trusted business partner as well as do the reporting and compliance stuff, they'll typically have fewer clients. If they're sitting with you and doing that, they're getting paid to sit with you and do that, as well as paid a little amount for the reporting and compliance.
Now, if you have it separately, do you have to then act like a sort of the person, say me, in the middle? Do I have to act as a sort of translator, like the business planner tells me that you should structure things this way? Okay, and now I'm telling the accountant.
Remember, anyone you bring into your business, they're all advisors, and it's actually quite healthy, I think, to have different bits of advice. So if you were to bring someone like me in to help plan your business and stuff, the remit for me is very different to the person doing reporting and compliance, okay? So all the things I'm suggesting to you they'll be not linked or depend on the recommendations of reporting and compliance for most things. There might be a few things which are linked. For example, if you're doing a side hustle which starts to become really good and now you want to continue doing that, you've made a decision, the 2 months is up, this is actually going really well, now I want to keep doing it, what do? I now want to bring it into my business or whatever, then I might rely upon the advice of your reporting and compliance guy to say, if you've got multiple businesses, the best thing might be trust arrangement or set up a separate company or do this one as a partnership with this one, keep this one in your name based on your personal situation, your liability or attitude to liability, all those sort of things. So I'll take that advice and say, okay, well, based on that advice, this is what you should do, and this, etc. So there'll be very little overlap. Certainly won't be any translation required, but you can actually find, I think, mentors or advisors. That's really how I term myself, sort of like an advisor. And as the name suggests, I'm giving you advice on how to run your business, not in your business, but on your business. Like how do you decide what to do, how much to do, when to stop, and what is your decision making on stopping? What is your decision making on like, as I said, on which one of your side activities to go to and why you're doing it? Be purposeful in that, be deliberate in that. Otherwise, you die by distraction. You don't want to die by distraction. You want to actually have purpose. And that's what a good advisor will help you do. Sort of advice will actually, I'm not the sort of person, people like me will not be the good people to do your reporting and compliance, because we don't do that every day of the week. That's what you want those reporting and compliance experts to do. Actually, they're way more efficient and cheaper to do that. But what I'm saying is, it is actually hard to find people who do that as well as act as incredibly good business advisors at the same time.
Got it.
Yeah.
And then what would your recommendation to find people that are good at sort of reporting and compliance? But because everyone can do it, your local accountant can do it. It's a pretty simple job, but you would need someone that is pretty good that can say, hey, based on your side hustle, maybe we should open up a second company. That requires a accountant with quite a bit of knowledge.
So look, the two startups that I've advised, one of them found them through their startup, I think it's called Fish Burners or something, down in Sydney, down near UTS. So it's a startup co-op space community, and they have lots of expert speakers and stuff, people coming in. There are actually companies who base themselves there, or you go and speak to the people there, and they'll actually offer their services to multiple startups. And so you can find people who kind of are experts in dealing with the requirements of small startups and things like that. The other one just found them through their networks. As I said, the power of networks. If you trust people, you know who they are, you ask them for recommendations. Like, I could recommend to you 3 good accounting firms who could do that. You may or may not choose to use them, but I've got 3 in my head I could tell you. Also, if you came to me for, I want someone to advise me on my business, I know myself and I know probably 2 other people that sort of do this sort of thing, but I could also suggest you speak to as well if I don't have time to do it, right? So using your LinkedIn networks of people who will take your call, ask them deliberately what you're looking for, see if they know anyone. Those networks really open up a world of things. You don't contact people you don't know. That's spamming. Mm-hmm. You contact people that you do know, that you've worked with, or would take your call. Or if you send them a message, would reply to your message. Like, those sort of people, and you know who they are. You know who would reply to your message because you've had some relationship in the past, versus people who may not reply to your message because you've had no relationship in the past with them. And they're the people you ask deliberate questions of to find advisors, mentors, etc. But the startup centres, there's a few of them in Sydney, not just Fish Burners, but there's a few others. They've got a range of people and experts that I think consult to a whole host of businesses that size as well. So, the Suburban Accountants, you can go to them as well, but there's nothing against them, but to me, it's like potluck. The sort of people you get in a Suburban Accountant could be amazing, could just be bare minimum people. Just you don't really know. That's why I'd more recommend you find other startups and ask them who they use and are they good, because often good people get recommended very easily.
That's a great tip, man. Lakun, I can go on forever, but I think we'll probably wrap it up. Is what's your advice for entrepreneurs that are maybe doing 100,000 a year, 200,000 a year, finance-wise? Well, what do you feel like is the most overlooked thing within businesses when it comes to the finance side of things? Do you recommend they study about it more? Do you recommend they track their numbers? What's your best piece of advice that you feel like is overlooked at the moment by a lot of small business owners?
Wow, that's a really great question. I'd probably say two things, actually. Number one, most overlooked thing is cash flow. In a small business, big business, etc., people are so invested in their business, their product, their customers, their sales, growing, whatever issue of the day is today, fixing an IT issue or sorting out a contract with a channel partner or whatever the issue is right now. That is your whole world right now. But as I said at the start of this conversation, you've got to have money coming in the door more than what's going out in the long run. Otherwise, you end up running out of money and having to close down. So your cash flow should be known. That doesn't mean you need to know every day, but it does mean you need to have a handle on it. So depending on the cycle of your business, if getting a once a month report is sufficient, because during the month, your business isn't going to vary that much during the month that it's going to be super cash rich and super cash poor, blah, blah, blah. But just if you can have a report once a week or once a fortnight or once a month, whatever that cadence is correct for your business, get that in place. So you measure for the last 30 days, how much money came in, how much money went out. And you should stick it on your wall. You should just know January minus 3,000, February minus 2,000, next month minus 1.5, next month minus 1. I can see a trend that my business is improving in a cash position. And then if it's going down, 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 I can see a trend it's going worse. If you're not aware of that as an owner and you just focus all your time on the activities to run your business, you're going to get a nasty shock. And this has happened to big businesses as well as small ones, you know. So cash flow is the number one thing that's overlooked because people assume everything's fine until suddenly it's not fine and it's too late because they haven't bothered to track it or measure it. The other thing that's overlooked, I think, actually is this is such a small thing, but it's really around structuring grants, entities, and things like that. So what I mean by that is, like, if you're running a startup, you don't just need to start a company. You can do things as a partnership, as a joint venture, as a trust, as a family trust, as a unit trust, as a discretionary trust. Just name 6 different ways you can structure a business, and each have their advantages and disadvantages, which are appropriate for businesses at different stages of their life. If you're starting up as a startup, you should never start up as a trust, okay? Because whilst a trust might protect your personal assets, all the losses you don't get to claim a tax deduction for until you make profits. So that could be 3 or 4 years away. You want something that you can claim straight away. Partnership or joint venture or something like that. If you structure as a company, again, if the company makes losses, you can't claim a tax deduction for it against any other personal income you have. But then if you just structure it as your own ABN personal business, you can claim everything if it's a loss against your other income, so you get the tax deduction. The only problem with that is your personal assets are exposed. So if you're doing something and someone sues you, then you're liable personally because it's your business. Whereas if they sue the company, they can only sue the assets of the company. Your personal assets have got a wall between them. So there's positives and disadvantages on structuring things. And then the whole world of grants. People forget there are government grants and incentives and stuff out there. And I think if you're a small business, you should be going after everything that's eligible for you in your industry. And you actually should be engaging some reporting and compliance expert to help find the eligibility criteria for those things as well.
That's amazing. That second tip you gave it's so amazing. Like, I think the importance of learning how to structure things correctly, as well as the importance of looking for grants. That second piece of advice, is that something that someone in reporting and compliance would know, or is it mainly advisors?
On that, if your reporting and compliance guy cannot give you the pros and cons of unit trust, discretionary trust, family trust, partnership, joint venture, individual ABN or company structure, is they don't know that. And they're actually pretty basic things, to be honest, in the world of legality. If they can't do that, then what you have is what I call the bare minimum reporting guy. The guy will do all your tax returns and payroll, this and that, whatever. That might be the suburban accountant kind of stuff, right? But, a good one will actually be able to explain in plain English to someone who doesn't do this, every day, of what are the pros and cons of each of them. But a good advisor should know all of this, because a good advisor, like someone like me with more than 20 years experience as a CFO, we know all this. This is like, you don't structure your companies very often. You only structure them when they start. So, and, you can change structures, of course. Sometimes it's cumbersome to change, but you can change them at any time as well. But you don't often change your corporate structure if it's a company, trust, individual. And you've got to know why you're doing it as well. So, if I look around, there's people I know who've got a family business that they've owned for 40 years, and they're now looking to sell it. But in this 40 years' time, they've run it through a family trust or something like that. You can't sell that. So they need to convert that to a company. Then there's tax implications of that. There's capital gains implications, or how can they do it so they benefit from the rollover exemption that's available under tax law, so that if I sell my business from a trust to a company, I don't want to have to pay tax just by doing that. So how do I structure it in that way? Like, they're the sort of things that's really worth paying tax advisors for. In that, it's when you reach that stage of your company life cycle, right? But in the intervening 40 years, that structure served its perfect purpose. That man wanted to have the income and distribute it amongst his family to lower his tax burden across his family. That's exactly what the trust enabled him to do, a discretionary family trust. He couldn't do that through a company structure, couldn't do that through another structure. And the good thing with a discretionary family trust, you can make a company as the trustee company. So if someone ever sues his business for unsafe products or whatever, they can only sue the assets of the company. So his personal home is never at risk. So that liability, he's got a shield. So that's an example of why, depending on your situation, your business, your attitude to liability, or what you're selling, you might have different structures that you choose to operate your business out of, right? And they can all have ABNs and bank accounts. So those structures don't change any of that. Every business can have a name, ABN, bank account. It's just what is the legal entity that it operates out of. I see a lot of people who run startups just start a company. It's cost $1,000 on ASIC, to get it set up and get some papers, or probably less now, I'm not sure. And a company provides you perfect protection. So if somebody sues your company, they can't get your assets, they can only get the company's assets. But the company, if it's making losses for 5 years, you never get to claim those losses. Only the company can claim those losses against the company's future profits. If the company never makes future profits, then you've spent 5 years losing money and not even getting a tax benefit for it. So, there's pros and cons. There's pros and cons to all these sort of things. And that's what really needs an individual discussion around any business owner, what their personal situation is, their business, how it's going to grow, because some people have dependents, some people don't, some people have got assets they wish to protect from, anyone potentially being sued, and some people have no major assets, but they don't really care. So they want the access to the tax deductions and the losses rather than protection against liability. So there's a whole range of things like that. As I said, if your mind is spinning, it's probably because this is not something that's talked about a lot.
Yeah.
It's one of those things that's overlooked, as well as the cash flow thing, I think, by business owners.
Amazing tips. Lakun, really, really appreciate your time today. Where can people, if someone's listening, they love your advice, where can they learn more from you, maybe potentially reach out to see if you can help them and offer your service? What do you recommend is? So
I think the easiest way to contact me or anyone like me is reach out to me on LinkedIn. My messages are always open. I'll obviously you've got my LinkedIn details, which I'll pass to you, Andy, so you can put it at the bottom of this video as well. But absolutely, reach out to me. Most people who are sort of in this area and willing to help will engage. Obviously, their DMs are open, so you can contact me on LinkedIn at any time. That's probably the best way for the best channel for this sort of stuff.
Awesome. Thank you again so much. I really appreciate your time today. I just love your passion and enthusiasm towards finance. You definitely know your stuff. Like, you got technical when you needed to. You were able to be really broad and give broad advice when you needed to. And we sort of really stressed every different point and asked many different questions, and you were able to answer them with no issues at all. So I really appreciate your time today, and hopefully the guests got the audience got a lot of value today. And yeah, thank you so much for your time today, Lakun.
No worries. Thank you so much, Andy.
Thank you so much, guys, for listening. Hopefully you guys got some value from this episode, and we'll see you guys next week. Peace.